You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, welcome back, everybody. Welcome back, Hamish. How you going? How's the week been treating you?
Yeah, it's good. It's good. Markets have been crazy.
Yeah.
This week.
Oh, man. It seems like the whole world's falling apart at the moment, to be perfectly honest. Man, just so much stuff going down. Frantic. Yeah. Like, I've been watching, I don't think we'll touch on it too much just because it's not relevant to what we talk about on the podcast, but just watching what's been happening over in America over the past, couple days, the past week is just insane. I mean, it looks like a flippin' civil war or something over there. It's intense, man.
Yeah, it's I can't imagine what it's like to be an American while all that's going on. Like, it's pretty unsettling, even though we're so far removed from it.
Yeah. Well, I just think that if I saw all of that activity and rioting or protesting or whatever, in Australia, I'd be like, that I don't think I would feel like I was in a lot of danger. But then you see these heavily armed police officers, and then you remember that in America, basically anyone could have a gun. And I'm like, whoa, man, that's actually actually makes me would make me very nervous. But it's a pretty crazy situation.
Despite
it just seems
that,
like
the market continues to go on a tear, and it's just it's
crazy, isn't it? Yeah.
It is kind of crazy how far removed the market is from what's going on right now. And I guess that has to be a reflection of where people expect the economy to be in the future. But it is kind of strange where unemployment levels are 15 million people in America are unemployed, and then the market goes up 3%. And then it's like, this riot's going on in this city and this city and this city, and the market goes up 3%. And
it's unreal.
It's strange to comprehend.
Yeah, you're right when you say the market is just so detached from the situation that we're seeing. It's just, I don't know. It's crazy. Stock market, you make no sense. Can you please come back down to earth? Please. I want to invest my money. Please help me do this. Help me achieve this dream of mine. Anyway. All right. Let's get through our sponsor and then let's get into it.
Yeah, so this week's episode is sponsored by Sharesight. So Sharesight is an application that I've been using over the past few years in order to track the performance of my stock portfolio. And the reason why I use it is because it's fantastic for keeping track of all of the different types of gains. So capital gains, dividends. If you have a dividend reinvestment plan, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out your capital gains, your dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT. Sharesight.com/young investors. And not only can you use that link to access a free plan, but if you want to sign up to a paid plan, you can also use that link to get 4 months free when you sign up to a yearly subscription. So particularly for people in Australia and New Zealand, where the end of the financial year is coming up and your tax time is coming up, this is something that may be very valuable for you. So go check it out if you're interested.
And probably good to get started with this program before the start of next financial year. So even if you wanted to just use it next year, you've got all of your investing details for the entire, 2021 financial year. Is this the 2020 financial year that's ending? Or is it
for most companies, I think most companies label it as the 2020.
Because it's halfway through the year here. So this is the end of the 2020 financial year and then the start of the 2021. So it must be named based on what year it ends in. That makes sense.
It is strange that we do that, isn't it? Why do we not just use a calendar year as a financial year?
I feel like it'd be easier. I'm like, why can't everyone just like have things
Why
finish?
can't we all be in this together?
Why can't
guys?
all years? Yeah, why can't all years be the same? Why can't all quarters be the same? It's like we're talking about Disney's Q2 2020 earnings at the same time as just standardize everything. Maybe
Yeah.
they don't do end of financial year at the end of the calendar year. Maybe it's because they don't want people trying to frantically work in December or January or something like that.
Yeah.
I mean, December, January is kind of like a holiday period in Australia, so maybe they don't want to crowd that with people actually working.
Yeah, that is true. And I've got a shocker. Maybe we can start with this story. I've got a
Right.
shocker of a company who labels their financial reports in probably the worst way I've ever seen.
Right,
So
okay.
Zoom video communications, a company that's been quite sort of hot at the moment just because of how many people have been sort of in lockdown and working from home and using Zoom services. But they reported their first quarter earnings for 2021.
What? What?
So if you
Hey,
want to,
no, that is the dumbest thing I've ever heard.
yeah, I had to check this twice because I was sure that I'd made a mistake. But
That is dumb.
yeah, they call this quarter. So that basically their financial year ends at the end of January. So they have 11 months of a year and then they have January. And for some reason, because they have 1 month in 2020, or they did last year, they call last year's financial report 2020 and this year is 2021, which makes zero sense to me.
God. Like, I know that around the world it can be different days. Like, today is different to what the day is in America. But last time I checked, I'm pretty sure we're all living in the same year.
Yeah, I don't know what to say.
Come on. They're probably like that's literally, I've never heard of that before. They must be the only company out there that's doing that. Anyway.
Yeah, they've lost their mind.
Did they have, so I imagine they'd probably have pretty staggering earnings for the quarter that's just gone. That's how I'm going to refer to it. The quarter that's just gone.
Yeah, first quarter of this current financial year. Yeah, so I mean, then their numbers were just off the charts. And I mean, the stock actually didn't move too much after this because the expectations were also off the charts. Because, I mean, particularly in Australia, at least, so that's kind of where I can draw example from. I know that most people were working from home during March, April, that kind of period. A lot are still working from home. And I know that, there's only a couple of really high quality video services that people use. I know Microsoft has one, Zoom has one. And they've been able to sort of capture a lot of revenue from not only individuals, but also corporations, which is their main business. But their revenue came in at $328 million for the quarter, which was up 169% year over year. So lots
That's
of
pretty
growth.
good.
Yeah, I mean, it's pretty impressive to grow. I think their last year quarter must have been about 150 million or something like that.
Right.
So huge growth there. And even more impressive, it kind of just gets more impressive as we go down. So I'm building up to the big numbers here. But income from operations grew from 1.6 million to 23.4 million.
Holy smokes.
Which when I saw this, I was thinking, wow, this company actually wasn't that big last year. $1.6 million in operating profit. It's big,
nothing.
but it's nothing really compared to a lot of
I wonder
other
what their
businesses.
market cap is right now.
Well, I'll get to that. All right.
Oh, sorry.
I'll get there.
Sorry.
I'm building
because
up.
like
Okay.
$1.6 million in income from operations, you would not imagine this company to have very high market cap.
You would not imagine that, but
no.
you.
Sorry, I'll let you keep talking.
Yeah, stop spoiling my story here. No, But yeah, so this is so free cash flow is sort of the next number we look at, and this one's my favorite. This one went from $15 million to $252 million, which represents 17 times year-over-year growth.
Jesus.
So and if you're wondering why there's such a massive discrepancy between income and cash flow, it's because a lot of these companies are paying up front for subscriptions that last for, say, a year. So basically, the income on the income statement will be representing how much of that subscription has been consumed by businesses using Zoom? How much has it been used up? Whereas cash flow represents just the money coming in. So they received a lot of money during that quarter for companies that were paying up front for, say, a yearly subscription. And a lot of companies pay, north of $100,000 per year for services for their company because obviously as an individual, it might be maybe $10 or $20 a month or something like that. But when you're a corporation and you have, maybe a couple hundred people using the Zoom services and that you want to sort of give it out to all of their employees,
it adds up.
It starts to add up. You can have these plans that can be $100,000, $200,000. So
wow, it's insane.
Yeah, so that number was my favorite, 17x year over year. But then in terms of the stock price, so as I said, the stock didn't really move on this news, but it has been moving over the past 6 months. So over the past 6 months, the stock is up 200%. And you were asking about that market cap. So yeah, they had income from operations of 23 million, and that was up from 1.6 million. Their market cap, the price for the whole business, is $60 billion.
60 billion.
Yeah. So I mean, if you compare 60 billion to their current earnings, you're paying 2,400 times earnings per share. So 2,400 times. Billion. Earnings per share, but that's and that's after the increase in profits from.
That's insane. $60 billion.
Yeah.
What?
Yeah, I saw.
Are they anticipating that this growth is going to continue for like the next 10 years?
I mean, they must be. I saw a couple of articles saying, could this become $100 billion company? And I'm thinking, wait a second. Last year they did 1.6 million in a quarter in profit.
Yeah.
Like that's nothing.
1.6 million in a quarter, and this $100 billion. That's like there's only 60 odd companies in the S&P 500 that have a market cap of over $100 billion.
Yeah.
That's like up there with the Netflixes, the banks, the Facebook, like all those companies, Disney and those sort of companies.
Yeah, people have gone a little bit mad. It's a little yeah.
I tell you what, I mean, it's a pretty nice position to be in if you're Zoom, because like obviously their business wouldn't have grown unless it would have grown, but not to obviously this extent without the shutdown. But now they've got the bonus of now that the shutdown has caused a lot of new customers to come on board, is that a lot of those customers will just stay on board. They'll be like, oh yeah, you remember how when we went into the lockdown and we started using Zoom, remember how good that was? We might just keep going with it. So
yeah, I think
just like, I don't think that their growth is going to continue like this forever, but they've definitely got a big boost just from, I don't know how to, like, almost getting customers that maybe they wouldn't have gotten otherwise. Customers that maybe didn't even know that Zoom existed. I find that interesting.
It kind of plays into a little bit of Ray Dalio's idea about this paradigm shift and how sort of things are going to be radically changed after this pandemic, that sort of the behavior of people. And I think one of those aspects is that a lot of businesses will recognize that it may be equally as profitable or even more profitable to have some employees just working from home and just communicating online and using services like Zoom to participate in meetings and that sort of thing. I know that there was a number of schools in Victoria that are discussing having permanently 1 day a week, which is online classes, which I have no idea how that would work for I guess the younger age groups. But it just sort of shows that there has been a dramatic shift in how people perceive working from home. And that'll certainly benefit companies like Zoom, but to what extent? To the extent where you're willing to pay 2,400 times earnings. I actually, like, how could you justify that at all? Like, I'm trying to think about what the growth would have to be to get that back down to a 10 PE.
Don't even think about it. I don't think anyone's brain can conceive numbers that are that high.
Yeah, it's crazy.
One thing that will be very interesting is whether this Zoom pops into Warren Buffett's next 13F. That'll be a hot topic of discussion. I think this kind of stock is right up Warren Buffett's alley. Technology, P of 2,400. Insane growth.
It's in the price range now. So
Yeah, exactly right. Exactly. Warren Buffett would be like, yeah, we bought Zoom. We've got nothing else to buy.
yeah, why not?
Zoom, the first $2 trillion company. Berkshire Hathaway sinks 50 billion into Zoom.
Oh dear.
Anyway.
Yeah. So I mean,
what an insane story.
yeah, it is kind of insane, and I think I don't know about you, but I'd expect that there'll be a little bit of a bubble pop happening for this stock, probably, sometime in the next couple of years. I think.
Yeah.
I mean, maybe they'll continue to run up over the rest of the year because they were growing quite quickly even prior to this lockdown. So it's likely they'll still be growing at a ridiculous rate, 50% per year or whatever, for maybe the rest of the year or something. But there will be a point in the future where investors kind of realize what they've paid for this investment, and it'll pop just like every other investment, kind of like Yahoo, which didn't have any earnings in 2000, and they had a market cap of $100 billion.
That's insane.
And then it went to $3 billion.
Yeah.
Very quickly. So you got to be careful of businesses like this. It might be a fantastic business, but you have to consider the price that you're paying for it. Super important.
Well, here's another crazy story. Imagine going to sleep one night and waking up the next morning, and overnight you're now $775 million richer.
Wow, that'd be
pretty nice.
Yeah.
Well, that's what happened to Elon Musk.
Wow.
So Elon, the story is that he earned his first tranche of his compensation plan. So essentially, well, I'll read you what the article says. The tranche is comprised of about 1.7 million shares of Tesla, and would be valued around 775 million this is from last Thursday. Based on last Thursday's closing market value, shares in Tesla closed about $805 on Thursday, and the options have a strike price of $350.
Oh.
Wowee. So it says Musk earned the first portion of his stock options for keeping the company's market capitalization at 100 billion on a 30-day and 6-month trailing average.
Right. Okay.
Musk, so he actually had to keep the market cap up there for a decent while. Musk does not take a salary at this point. He owned about 18.5% of the company as of May the 1st, according to FactSet, a stake worth about $24 billion. By Thursday, the proxy filing revealed Musk's stake in the company had risen to 20.8%, a total of 38.7 million shares. So he's gone from 18.5% ownership to 20.8% ownership, and this is just the first tranche of his compensation plan. The full award is set to vest over 12 tranches with different milestone requirements, reaching up to 650 billion in market capitalization.
Wow. So there's 11 more that he could hit.
Potentially, yes.
Wow.
Potentially.
Okay. And this compensation is in options?
I believe so, yeah.
Okay.
I'm not sure. If I remember it correctly, I think they've all got a strike price of 350. So I think the deal gets better the higher the market cap goes.
Right. Okay. Yeah. So basically, that would mean he'd have the option to buy those shares at $350 per share.
Yeah.
Okay.
Yeah.
Interesting. Yeah.
It's pretty insane. But if the whole compensation plan is even like if all 12 tranches are based around a strike price of 350, imagine like the 12th tranche. Imagine if he gets that.
Yeah, because the market cap has to be over 650 billion. Is that right?
650. I don't even know what that would do to the share, like what the share price would be, but it would be like thousands of dollars.
Yeah. Well, I imagine the current market cap's around 100 billion, right? 160. So
right. Okay.
So you're looking at a 4x at least. I'm just doing approximate maths.
Wow.
4x in the price from here. So it means he'd be buying shares at 350 and making 8x on them if he sold them immediately.
It's insane. It's insane. Anyway, well done to him because he has certainly put his heart and soul into that company, I can tell you.
Yeah.
It's crazy even just like reading things like when they were ramping up the Model 3 and how he was sleeping on the factory floor and waking up in the factory the next day to completely reprogram the assembly line by himself. Just like, man, that's nuts. That's dedication to the cause.
Yeah, he's certainly a hard worker.
Yeah, and he's now certainly well paid.
Yeah, I would presume that it's probably likely that, considering his sort of the fact that Tesla is his kind of his baby, it's likely he would hold on to a substantial amount of those shares. It's not as if he would be the kind of CEO who would be exercising options and just selling the shares immediately and taking profits off the table, if that makes sense.
Yeah, I imagine he'd hold his shares for a long time. I think eventually he's going to sell. One day I think he's going to sell everything, that like literally everything in Tesla, just to try and fund getting to Mars. I think that that's Elon's number one goal, is just getting to Mars. And I think eventually there'll become a time where he'll just be like, right, before I die, I've got to put everything I can possibly get my hands on into trying to help this Mars mission.
Yeah.
I feel like that's the way it's going to work. But obviously, like you would want to hold. I mean, if he's going to be the CEO of Tesla for the next, say, 10 years, and he can see substantial growth in that company over that time, yeah, you just hold your shares and let them, grow in value.
Definitely. Yeah. Speaking of shares being handed out.
What a segue. Hamish Hodder, what a segue. Whew.
So we had a story. I had someone on Instagram message me and asked to talk about this story, so I thought we would briefly. So Woolworths, Australian company, issued 57 or approximately, it's expected to be approximately $57 million worth of shares to their staff. So that's kind of in relation to the fact that Woolworths has been one of those businesses that has benefited tremendously from the lockdown. I think some of their stores, their revenues were up 40-50% during that period, just because of some of the panic buying, I guess, people were doing. So as a result, there's the management team at Woolworths is giving out bonuses mostly in the form of shares. So basically, approximately 100,000 shares, 100,000 staff will become Woolworths shareholders. So full-timers are expected to receive $750 worth of stock and a $250 gift card to Woolworths. Part-timers are given shares on a pro rata basis, so in proportion to how many hours they worked, as well as a $250 gift card. And then nice. Casual workers get a $100 gift card. So, not the greatest if you're a casual and you were working quite a lot of hours. I saw a couple of comments of people saying that, if you were a casual and you worked pretty much full time during the pandemic, then you still get your $100 gift card. Whereas the part timers, if you worked full time, since you're getting shares on a pro rata basis, if you worked the same length as a full time employee, then you will be getting the same amount of shares.
Yeah, wow, there you go. So actually, I think first of all, I think that it's nice that Woolworths are doing this. But yeah, I agree. Like the casuals would feel ripped off, especially if they've been working heaps over the past couple months.
Yeah, they could have certainly done. They could have certainly paid it out all on a pro rata basis, which I think makes the most sense. If you probably contribute more hours, then you should get more of a bonus. And I think, we could sit here and debate whether it's enough and, it's not enough or it is too much, but that's kind of a bit of a guessing game. And it is good that they give something back.
Well, this is like a bonus, isn't it?
It is, yeah. It's like a bonus. Yeah.
So, really, you could argue that Woolworths didn't have to do this at all.
That's true.
The law says that you have to pay your workers for the time they worked, and Woolworths have done that. So, really, this is all of this is a bonus, I suppose. So, I feel like it's worth remembering that. I think that it's fair that they have given this bonus, because obviously these workers have worked so incredibly hard over the past little while and have probably had to deal with some absolutely terrible conditions, like dealing with customers and dealing with the hoarding and all of that stuff. They've had to deal with all of this just horrible conditions, and the fact that they're in a place where, is probably more prone to having people with coronavirus walk through it, just by the sheer amount of people from all walks of life that go through supermarkets. So
yeah, that's a good point. Actually, it's a bit of it was one of the, I guess, higher risk jobs that
definitely
people were still. During the lockdown, a lot of people were just at home or working from home. But if you were at Woolworths, then you were still working full time and being exposed to all of the people coming through. But Yeah, another sort of negative thing that could be negative about this, it could be also be positive, but some were hoping for more of a cash bonus because these shares go under the Woolworths program whereby you can't sell these shares for 3 years unless you quit.
Bugger.
So basically, it incentivizes you to hold them over the long term, which is positive for those who obviously care about the long-term growth of the company and contributing to, I don't know, a bigger goal or something like that. But it's not so great for those who are looking for some personal relief, I guess, for some of their bills and that sort of thing, being a combination of stock and then a gift card. I guess the gift card sort of can be used to relieve some grocery bills, grocery expenses, but yeah, I get that some people were sort of expecting a cash bonus, and I guess that could be that is disappointing.
Yeah,
true.
But I don't know. Yeah, personally, I don't think I'd like to hold Woolworths stock.
No, I probably wouldn't either.
If I had Woolworths stock, I'd just be like, man, can I just sell this, please? Please.
That's the other thing that I was thinking about is that from our perspective as investors. The other question that we would be wanting to be asking if we were investors of Woolworths is whether shareholders got a good deal, whether the stock is overvalued or undervalued. Because typically, if the share price is undervalued, then you want the company to be repurchasing stock and increasing the percentage ownership for each share. But when the stock is overvalued, you want them to be issuing shares, getting the most value out of each of those shares they're sort of diluting the pool by. And I think considering the fact that Woolworths has done so well, I haven't actually looked at their stock price, but I would presume their stock price has held up relatively well over the past few months. So based on that, you could maybe argue that it was a good idea to issue shares rather than using cash. But it's not a business that I've looked into, so I don't really know I don't know the value of or what I think the value of Woolworths is. So that's a question for someone who does understand that business and is investing.
The stock dropped like with everything in February. I'm just looking at it now, but it didn't drop as far, nowhere near as far. In fact, since the third week of February, it's only down 15%. So it's not like the 35%, 50% that some other companies have experienced.
Right. Okay.
Sorry, I just wanted to check. That's all. But yeah, I mean, overall, I guess whatever. I mean, it's nice. It's a good thing for Woolworths to be doing. At least they're giving their staff something, considering that Woolworths have had so much business and the staff have worked so hard.
Yeah, definitely.
What was I going to say? That's right. A news story that I saw that related to this whole Woolworths coronavirus panic, all that sort of stuff, is that there was a study done by a couple of academics out of UNSW, and apparently Australians were almost worst in the world when it came to panic buying as coronavirus took hold. So the article reads, University of New South Wales academics Mike Keane and Tim Neal have used statistics from 54 nations from January to April to compile a panic index, which shows just how intense the stockpiling behavior was in different countries. This is what Dr. Neal had to say. The data shows we can explain the timing and severity of panic buying by using information on the spread of the virus and government policy announcements. But Australia is one of the few countries where this is not true. We panicked earlier than most countries in the sample, and it's very hard to explain. Notably, even countries that were hit hard by COVID-19 early, like Italy, panicked in mid-March, while we panicked at the start of March. This is pretty crazy. Unlike other countries, the escalation in panic does not appear to correspond with any significant increase in domestic COVID-19 cases. Good work, Aussies. Let's go. Get around us. Gosh.
Yeah,
we're just scaredy cats. What can we say?
It must have just caught on in the media and on social media.
Must have.
Earlier than that. I mean, I just remember every news night, it was kind of like, it kind of just helped ramp it up. Every news story of there's no toilet paper in 6 out of 7 store, like, you know.
Oh my God.
Yeah.
Get the toilet paper. This line I love that line. Unlike in other countries, the escalation in panic does not appear to correspond with any significant increase in domestic COVID-19 cases.
That's funny.
That's basically just a politically correct way of saying, Australians, what are you doing?
Relax. Calm down.
Oh, it's so funny. You need to calm down.
Oh dear. Yeah.
Oh, that's so funny. It's so true though, man. Like, my girlfriend was saying when she walked out of work at lunchtime one day in February, and she was just walking to the shops. She was just going to buy something from the shops to have a snack on for lunch. And then apparently the word got out the IGA was restocking their toilet paper, and she was saying there were like cars pulling into the parking lot and people like sprinting into this IGA just to get like jumping on this toilet paper just to grab some. I was like, oh my God. And just seeing it happen, it was just so, I mean, the other point they made in this article was that essentially they were just saying in politically correct terms that Australians are stupid for hoarding toilet paper because toilet paper is not a necessary item when it comes to coronavirus. I think they said something like coronavirus doesn't cause diarrhea or something like that. Where they were saying like we can understand there being panic buying for hand sanitizer and personal protective equipment, but when it comes to toilet paper, just doesn't make sense. Just doesn't make sense.
Don't do it, guys. Always keep a spare pack in your
exactly
in your cupboard, and just stay calm. I think it's one of those things.
A spare pack or 25 in your cupboard.
It's one of those things people don't think about, and then when it sort of was confronted that there might not be any toilet paper, people kind of it's kind of one of those like sensitive things. People are like, no, I can't go without it.
Oh dear, yeah, that's true. Well, what you gonna do? Where are the tissues at?
Oh dear.
Oh gosh, best not to go down that rabbit hole.
Yeah, let's not go there. In other Australian news, so we had the GDP numbers for the first quarter come out.
Right. Okay.
And this was interesting because we know that in the second quarter, we don't have the data yet, but in the second quarter of 2020. We know we are very likely going to see negative GDP growth. So,
well, Frydenberg already confirmed it. He said in some like press release or interview or something like the other day that he said unofficially, yes, like Australia is definitely in a recession.
Yeah, exactly.
So he's obviously looking at these numbers before they're released, and he's going, guys, no, it's happening. It's
confirmed.
Happening.
Yeah, yeah. So in the first quarter, it declined just 0.3%, so relatively small decline, but that is expected to grow, will decline even further in Q2. I think there was some estimates I saw that range between -8% to -10% for Q2,
and that's big. That's really big for GDP. That is
for GDP. Yeah.
So I think what was a depression? It's defined as. I don't want to look up depression, mental illness, depression economics. I think that Ray Dalio anyway was talking about a depression being like just a 5% decline in GDP, which as a number, 5% doesn't actually sound like all that much. But when you consider that that's actually like the gross domestic product, that's like an entire country, then that's actually pretty big numbers. So it actually doesn't take too much of a decline in GDP for things to actually get pretty hairy. So what were you saying before that? They're estimating what, -8
to 10% is a couple of the estimates I saw. Yeah.
Right. Okay. So that is like really quite drastic in the grand scheme of things for GDP. So
yeah. It'll actually be interesting to see what it is for Australia, but also the US, because I remember when this pandemic was kind of snowballing a little bit, there was it felt as though there was a lot of firms in the US that were kind of competing to have the most dire outcome for Q2. Like it was like it was like JP Morgan says -15%. It's like Goldman Sachs says -28%. It felt like it was just kind of a competition for how bad it's going to be. So
well, I guess it's free advertising for them. If they have the most outrageous numbers, then they're going to get quoted in the news stories.
Yeah.
But then again, if they're wrong, they also have the most. They stand to lose the most in reputation. But then again, I don't even know if some of these places care about their reputation.
No one ever checks if you're wrong, though. They only know if you're right. No one ever looks back.
That's so true. So true.
So many people just yell and scream opinions after opinion, and no one goes back and checks when you're wrong. But when you're right, and they find the article or the video, and they're like, "Oh my goodness, you're an oracle."
Maybe we should use that tactic. Maybe every podcast from now we should make one outrageous claim.
Yeah.
And then if we do enough podcasts, then each time we'll each make our own outrageous claim, and then eventually one of them will be right, and it will just make for the best clip. We'll just chop that clip without any context, and we'll just blast it all over our social media. So,
I mean, you're saying that with a little bit of cynicism, but there are people who genuinely do that.
Yeah. There's literally people that do that. All right, let's start right now. Gosh, Hamish, I don't know what to tell you, but what is it now? The 4th of June. I reckon that before the year's out, the Australian economy is going to go down by 20%. All right, I'll start that again. Well, Hamish, I don't know what to tell you. I'm sitting here on the 4th of June, 2020. I reckon before the year's out, the Australian economy is going to go down by 25%.
By 19%. By 18.5. By
18.
Just cover all bases here.
Yeah, exactly right. Hamish, I don't know what to tell you. Oh, dear. But you're right. Some people do actually do that. It's hilarious.
Yeah.
It's so funny.
Yeah, I mean,
I think Gary V is kind of guilty of that.
I had him in my mind. Yeah, I mean, he has he because all of his content is just snippet sort of content, and he says a lot of stuff.
Yeah, he just blah 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 blah. He just keeps going and going. He just keeps talking.
Yeah,
and then he's pulling back. Like, I'm pretty sure he would have had every single opinion about every single issue that it has ever existed in. Like, he's probably said some positive things about this and some negative things about this, and then conveniently 5 years later he'll just pluck the clips that that suit what happened.
Yeah, I mean, I don't know what's more hilarious, people doing it or the fact that it works.
I know. It's crazy. Yeah. It's like I've been watching, for instance, on the Financial Education channel recently. I saw a video which is like, is there going to be a stock market crash in June 2020?
Yeah.
And then last month there was one which was called, is there going to be a stock market crash in April or May? And then the month before that was April. The month before that was February. So March, February.
Man, he makes one of those videos like twice a week. It's actually,
It's kind of funny, but I mean, it works. Like exactly what, like it works.
Yeah, the comments on the most recent one were pretty funny though. There was a lot being like, if you make a video like this every week, you've got to be right eventually. And like people actually starting to catch on that he's done literally the same video, just crash coming in June, crash coming in May, crash coming in April.
Yeah.
Yeah.
That's pretty crazy. Anyway.
So there's a little snippet of a rant there that we typically save for off air.
Yeah. I mean, it's just funny. I mean, you can apply this to any YouTube. I mean, YouTubers just make content that's going to generate clicks, really. I mean, we try and be pretty ethical about it and actually create good content. But I mean, a lot of people, and I'm not saying that the Financial Education channel is specifically this. I'm saying a lot of just YouTubers in general, they don't really make content to try and, to make the best content they can possibly make. They just make content to generate a lot of clicks, which, it is just the way that the media in general works at the moment. So it's just, I mean, if there's a video to be made and it's going to generate a lot of clicks, then people are going to be making those videos.
Yeah. I think, a lot of people sort of go down that rabbit hole of sort of making content that is what is being searched the most this week, for example. Whereas I've kind of found myself drifting more towards what I would call sort of evergreen content. That is kind of content that will appear in search terms and that is relevant for the next year. I just can't, I don't know. I do it occasionally, but I don't have the heart to make a video that I know is not relevant after the first 4 days or the first 5 days.
Long term, it's just not a good decision. I mean, some things are so big that I just want to talk about them, and I do that.
There's that,
but you definitely, as a YouTuber, you don't want to make content that's going to be thriving in a year, 2 years, 3, 5 years from now. It's like the difference between making a video which is like, oh my God, the Fed lowered interest rates, versus like, this is how to effectively diversify a portfolio. It's like one of those videos is going to be valuable forever.
Yeah.
The other one's going to be valuable for about a week.
Yeah.
If it's valuable at all.
Pretty much. Yeah. I mean, I was just looking at my ad revenue the other day, and I think about half of my monthly ad revenue comes from 2 videos. One I made over 2 years ago and one I made about a year ago.
It's pretty insane.
Like most of the ad revenue that's generated on the channel comes from content that I made a long time ago and that I intended to be relevant for a long time. And that's where I'd prefer to make content. But yeah, certainly if you're always on the next hottest topic, even if it's not even related to finance, if it's just something people are searching, then you have to keep doing it. You have to show up every week and you have to keep making that just to keep the views coming in. You have to keep making that latest content. Anyway, we're drifting now. What were we even talking about? I can't even remember. I don't know. We're talking about GDP.
GDP. How did we get into talking about this? I can't even remember now.
I don't know. Oh, we're making predictions. That's right. We're making predictions.
Making predictions. That, of course. Is that all we've got to talk about for GDP? I mean,
yeah, that is. Yeah, I think that's just about it.
Yes, Australia will be in a recession, but you could have guessed that. What else did I want to talk about? How are we going for time? 41 minutes. I'll just chuck this one in quickly because I think it just came out today. Is that today being Thursday, the home builder package was announced by the Australian government to try and stimulate the construction industry. So this is another form of stimulus that the government is putting in place. So what they're doing this time is they're going to give $25,000 cash grants, depending on what part of the country you're from. Do you say grants or grants?
I say grant. Yeah.
Grant, I say grant. I'm from South Australia, so there you go. $25,000 cash grants for new homes and renos from midnight tonight. To qualify for home builder, you need to be building a new home worth less than $750,000, or if you're renovating an existing property, it needs to have been previously valued at less than $1.5 million. So applicants for home builder must also meet the following 2 income caps to qualify for the scheme. Singles must be earning $125,000 or less based on their 2018-2019 tax return. Or later. Couples must have combined income of less than $200,000 based on their tax returns. So the cash splash will be offered for any contracts entered into between the 4th of June 2020 and the 31st of December 2020.
Cool.
So interesting. Like, I don't know, it's a pretty good deal. I mean, if you were thinking about building a new home anyway, or if you're thinking about doing big renovations, then this is just falling into your lap.
Yeah, it's a substantial amount of money, and I guess it's just another way that you can, as a first home buyer, you can sort of access some money from the government and get in a little bit easier into a property, hopefully.
Although I think you have to be, like, you can't be buying a new home. You specifically have to be building a new home.
Yeah, exactly.
I don't know, but for a lot of first home buyers anyway, that's the route that they go down.
Yeah, exactly. There's already, I think, what's the grant for if you're buying a new home? I think it's maybe $15,000 or $20,000 or something at the moment. So this is kind of another way that if you were planning on buying something and then renovating, or buying or building a new home, then it's good for people, as long as housing prices don't just go up to reflect the
Yeah,
fact that
yeah, exactly.
you're getting some money from the government. But
Yeah, or the fees that are going to be charged by the construction companies or anything like that. Because it's like, 25,000, that doesn't go to you, that goes to us.
Oh, yeah, that's actually true. There would be definitely some construction companies taking advantage of knowing that people are not spending their own money. This is it's been one of the. This is kind of like this is going on a bit of a rant, but it's also why there are some issues with something like the HECS for uni degrees. Is that the universities know that the 18-year-old isn't paying out of pocket. They're not thinking about how much money it's costing. Like it's coming. They know that they can push their prices up because they know that the person may not be considering the cost as much as they would as if it was their own money. But that's a rant for another day.
Yeah, and I've already seen some people criticize this home builder package, essentially saying, if you want to renovate your home, well done. While there are still, people suffering through unemployment or whatever, then congratulations if you wanted to do up your kitchen. But I think, I can understand where that argument is coming from. However, I think it's important to remember that this is not just free money for, it's not designed to just give free money to people that want to do a home reno. Really, the money is designed as a way to stimulate the construction industry, which is currently being decimated. So while it's given to the people that are going to do the renovations and are going to do are going to build their own homes, really that money will end up with the people in the construction industry, which is what they're trying to do. Because obviously, construction industry is getting slaughtered, people being stood down, unemployed, whatever. They want to try and get some, free up people to engage in the services that the construction industry offers, I suppose.
And I think there's about 1 million people in Australia that are employed in the construction industry.
Yeah,
so
wouldn't surprise me at all.
There's a lot of people who
Yeah.
rely on projects like this. And if there's going to be a dramatic drop off in the number of projects, then it's definitely a good way, or it's one way at least to stimulate some jobs in that area.
Yeah. Yeah. I think that's it for the world of news this week.
Yeah, that's it. We should get into some Q&A.
Yeah, we'll just do a couple. We actually got a lot of Q&A questions, so we really appreciate you guys sending in all of the questions, and we'll try our best to get to all of them. We're under a little bit of time pressure today, so we'll just do a few of them, but we stockpile questions, so we're going to come back next week, and if we don't get to your question, then we'll get to it next week or the week after that, until eventually this podcast becomes irrelevant and we run out of questions completely and we shut it all down. All right. Where should we start? What question should we start off with? How about I ask you this one here?
Okay.
Hey boys, Carlos here. I live in Melbourne. Love your podcast. Discovered it quite recently and now I'm playing catch up with all of the episodes release. Oh, thanks very much, Carlos. Two-part question. You emphasize on how important staying constant is. And that is that constancy focused on ETF to average the market return, or would you utilize it on individual stocks as well? Might seem like a silly question, but I've recently started in the investment world. The second part, would you stick to just one ETF that mimics one market, or would you have a couple of ETFs following different markets? Thanks in advance and thanks for the work.
Yeah.
All right. Well, thanks, Carlos. What do you think of this?
Yeah, thanks for the question. Very interesting. In terms of ETF, so in terms of, I guess, a broad Australian tracking or US tracking ETF, I mean, historically, they've gone up over time, which is kind of why we want to be investing into these. But in terms of what kind of return they will generate, that's something that I think is a bit of an unknown. And as a result, that's kind of why we have the dollar cost average plan, where you just consistently add to it, knowing that as the Australian economy or the US economy grows over time, that ETF will grow. To what extent, we don't know, so we just want to capture the average. But when it comes to individual businesses, if you do understand the business, I think you have a little bit more control over or an understanding over where the company could be in the future. And as a result, you can be a little bit more selective as to when you want to invest based on what kind of return you want to make. So that's kind of where I sit with the difference between just being consistently investing into an ETF versus strategically purchasing individual businesses when they're below a certain price. Did you want to comment on that before we go into the next part of that?
we had a very similar question, which I actually chucked in here from another viewer who said, isn't buying a stock at a 50% margin of safety just another form of timing the market? So this kind of relates back to what we're talking about. I think when you're talking about ETFs, it's tracking the whole market. It is impossible to predict how the whole market will perform in the next week, the next month, the next year. So for me, if I'm passive investing, I just want to stick to my schedule. Dollar cost average has been proven to work over a long period of time if you're tracking the market being a passive investor. So that's the whole idea of constantly investing or periodically investing. I only really think about that with ETFs. I will always wait until I have a margin of safety when it comes to an individual business before I invest in it. Because what you're saying, yeah, I totally agree, is that when it comes to an individual business, you're not just waiting for the whole market to crash before you can buy it. There are lots of things that can influence the price of an individual business, whether it's the market as a whole, the industry, or something specific to the company, or, you know, even something that's been made up that isn't actually going to impact the company. So when it comes to the consistency, I'm really just thinking, or the periodic investing, I'm really just thinking about ETFs. And then I would still have some level of consistency if I had the opportunity to buy the stock I was interested in at a margin of safety price.
Correct. Yeah.
So I would not dump all my money in as soon as I saw 50% margin of safety or 30% margin of safety. The quote is buy slow. So
yeah.
I would ease into that, and then, you know, in a month's time, if it's still there, I would put maybe another parcel in. If it's gotten even cheaper, then I'm getting an increasingly better deal, and I would kind of do that. But yeah, generally just the consistency aspect of it is just for ETFs.
Yeah. I just want to answer that second question that we had that was related to this, in that isn't sort of buying at a margin of safety a form of timing the market. And I'll tell you why it's not. So timing the market, to me at least, is trading in and out of businesses based on where you think the stock price of the stock price of that particular business will go. And that is not what I'm doing when I'm buying a stock at a 50% margin of safety. If I buy into a business, I have no idea if the stock will go up or down from that point over the next year or so. I just know that the price that I'm getting is fair compared to what cash flows I expect to get out of that business, what the business will actually produce. So when I buy a business, I'm not thinking this is the bottom, it's going up from here. I know that it will go up over the long term, or I feel confident that it will, but it could go down another 50%. And that's not me. And by accepting that you don't know where the market will go, whether it will go down further in the short term or up, is distinctly different from timing, where you're trying to pick the bottom based on, you know, a bunch of other factors. So I just wanted to comment on that. But the second part of that question was in relation to the number of ETFs that you use. So, I think you could probably, there's argument for having either one ETF or having multiple. I personally just have the one in the ASX 300, so it tracks the top 300 companies in Australia. Although I could certainly see myself splitting that money between the Australian market and the US market sometime over the long term. So I always keep about 10 or 15% of my portfolio in an index fund. So maybe over time that will go from just being the Australian market to being the Australian and US. And there's definitely an argument to be made that you could, having a couple of different ETFs in different economies can sort of give you a better return of the overall global economy rather than one sort of focused economy like Australia, for example. But at the moment, I personally just have the one. How about yourself, Brandon?
I think I've just got ASX 300 and S&P 500.
Cool.
And that's pretty much what I'm trying to do with passive investing, is track the Australian market and track the American market.
Right.
I think that in the long term, I feel like the American market will outperform the Australian market. That's just my own personal prediction. Both like developed economies, both developed stock markets. Obviously, we have the contextual factor of living in Australia, so that's why I track the Australian market. And then I really like the American businesses. I feel like a lot of the innovation that happens in the world comes out of America. A lot of the products and services that we use every day that are that are so helpful come from America. So I like to have exposure to that as well.
Yeah, that's it, isn't it? I think that in the US, there's a lot more consumer related businesses that are really successful. Whereas in Australia, if you look at the biggest companies, they're mostly mining or finance, which is not. I mean,
pretty much.
The mining companies are not consumer facing, but finance is a little bit. But it's just that's a whole monster in of itself. But it's refreshing to have businesses that are. They just have one product, for example. It might be a phone that they sell, and they can be a huge company. And yeah, I agree. I like investing in businesses like that as well. Should I? I'll ask one to you. How about I ask this one to you?
Yeah, go for it.
So, hey guys, this may seem like a silly question. There's no such thing.
Silly questions.
Yeah, it's the second.
It's never a silly question. Literally, ask us whatever the hell you want to know about.
Yeah, it's no such thing. But I was wondering, how do you find companies to invest in? For example, small cap stocks. And
that is such a silly question. No, I'm just kidding. How do I find companies to invest in, like small cap stocks, and are there any in Australia? How I find companies to invest in. So a lot of people try and, read the Motley Fool, and they try and watch CNBC or like whatever to try and find the next stock, the next undervalued stock, the next big thing or whatever. But that's not the approach that I take when I'm trying to find investments, because I always invest within my own interests and values and within my own circle of competence. So the way that I go about finding companies that might be interesting investments is I start out by writing down what my interests are, what I know a lot about, and what I am super passionate about. And, once I've jotted down a couple of different topics, then I'll go and I'll research. Okay, I like entertainment. I like video games and Netflix, and I love watching Netflix shows or watching movies. Like that's right up my alley. Playing video games. So then I'll look up. What are some video game stocks that are out there, and then I'll have a look at, what are some movie-related stocks that are out there? What are some, television-related stocks out there? And, Google will give you a massive long list, and then you can start to read into these companies. Now, you might read into ones that are absolute, like, dog shit, to be honest, like really bad companies. But you start to get a feel for the industry, right? So I'll start to learn more about, how the studio entertainment industry or the movie industry works. And then you kind of learn who the big players are, whether some of these companies have moats, who's putting who out of business, who's putting the pressure on who. And that leads me to eventually come into those companies that I'm like, actually, this is a great company. And then, of course, you just wait until it's at a margin of safety price to say, yep, this is a great investment. But
yeah. Sorry,
that's a long-winded answer, man. I just went crazy.
Brandon,
on that one,
what if I told you this is a family-friendly podcast? Okay.
Yeah, I'm just kidding. We don't drop f-bombs.
Yeah, we keep it.
We could be worse. What's the worst that we say? Probably shit. That's probably the worst thing we say.
13 plus.
Sorry. Yeah, no. we'll have to market it as PG-13 or whatever it is these days.
No, I follow the exact same approach as you, and I think one thing that I caught on to that I didn't realize at the beginning is that you don't have to search on Google for industries those rigid industries and just look through those lists. You can search for anything that you're interested in. Like
pretty much.
I looked up sort of coffee related publicly traded businesses or publicly traded stocks, and then you get obviously Starbucks at the top, but then not only do you have sort of coffee shop chains, you have coffee growers and people who deal in coffee commodities, and there's that way you can sort of access all of the different industries that are related to a particular topic that you might be passionate about. And I think that's the best way to go about it, because I think too many people use stock screeners and they put in these sort of rigid, classic air quote value investing ratios and that sort of thing, and then they end up trying to learn about businesses in industries that are out of their depth. Whereas flip it around. Start with industries that you know a little bit about, you're a consumer in, you're interested in, maybe you've worked in that industry, and come at it from that angle. And you'll have a much better time at sort of fishing out all of the, as Brandon would say, dog shit companies.
All right, I apologize for my terminology. I hope you can all forgive me.
I think that's it.
No, but I think you raise a really good point, because you're exactly right. If you are super interested in something like coffee, then you're going to be interested in places that sell coffee. You're going to be interested in places that grow coffee. You know, I don't even know anything about coffee. I don't even drink coffee, but like, different, types of beans and where it's who grows them and where does it get processed and how does it get turned. Pretty much if you're someone that loves coffee, you can probably take an interest in any part of the process, and you can find companies in any part of that process. I'm trying to think of another example, but I'm just blanking at the moment, so I don't know. But yeah, you raise a very good point there. But I think that's where we'll wrap it up. We're just pretty much smack bang on an hour, so I think we'll close things out. We've still got so many questions to get through, so we'll get through them next week or the week after. But keep sending them in. Like, we love seeing your guys' questions. So head over to the Young Investors Podcast on YouTube and find the most recent podcast episode and leave a comment on that video. And that's where we take all these comments from and we chuck them in here and we talk about them. So we really appreciate you guys leaving questions. We appreciate you guys listening. So thanks very much. We respect and appreciate your 1 hour per week that you give this podcast, and we thank you for your ongoing support. And we'll be back next week. Man, we are just doing so well with the podcast this year.
We're doing great. We are just
consistency.
21 weeks away from the big 100.
Here we go. But I tell you what, the reason why is because we used to record on a Saturday, and Saturday is just such a hard day to get things done. Yeah. Like so much stuff pops up on a Saturday.
Yeah.
Now that we recorded on the Thursday, it's just so much. Like, we always know that who's going to take time away from us on a Thursday morning? No one.
That's a good point.
Like, everyone's at work. Like, everyone's busy. So no, but it's good. It's good that we're consistent. Anyway, Guess what, Hamish? I'm rambling again at the end of the podcast. Who would have thought? Anyway, thanks everyone.
Who would have thought that? Thanks everyone for listening. Thanks to our sponsor, Sharesight. Go check it out if you're interested. Again, you can get a free plan, sharesight.com/young investors, or you can sign up to a paid plan and get 4 months free when you sign up to a yearly subscription. So go check that out. And we couldn't do this without Sharesight, and of course with our loyal viewership. So thanks everyone for listening, and thanks Brandon for joining us as always.
That's all right.
And we'll see you guys later. See you guys.
Bye-bye.
Have a good weekend.